Good morning, everyone. Thank you so much for being on this presentation today. My name is Stephen Jagard. I am the 529 specialist covering the Northeast states at John Hancock Investment Management. I've been invited on by Dean Fox and the Flagship Financial Group to present a little bit to everyone on 529s. We do have a John Hancock 529 plan, but this presentation is going to be solely about education and the general education planning and 529 landscape. So nothing specific to our plan. So Dean and company, thank you so much for including me, and I'll kind of dive right into things. There are a few slides I'm going to skip over as we go. I want to keep things relevant and in a timely manner. So we'll kind of dive right through it. So first and foremost, why is college so important? Well, a handful of reasons. I think some of these are pretty straightforward for most people, but the big ones that I wanted to just highlight, career-wise, you're likely to have more job opportunities. You're likely to make more money over the course of your career. If you could see that stat up there, it's about 72% more over the entirety of your career. And you tend to experience less unemployment. So you're more likely to retain your job, and finding a job will be a lot easier. The downside of this entire equation, though, is that college is incredibly expensive. Universities are incredibly expensive, and that trend is only going to continue. If you look back in the last roughly 30, 40 years, it's been going up at about a 5 to 6% clip per year. And that trend, again, does not look like it's going to stop anytime soon. So, of course, people are concerned when it comes to paying for education. 63% of families said that they think they won't have enough money to pay for college, and 82% say that it is going to be very necessary for them to need some sort of financial aid, whether that's from the government, whether that's in the form of merit-based aid from the schools, maybe it's scholarships, and unfortunately, maybe they even feel they have to take out loans. So all the more reason why 529 plans are becoming more and more popular as the years have gone on. So the way this presentation works, it's a little bit different. It's kind of 10 questions that are really set up in like a true false situation. I'll kind of go through them, as is. And of course, feel free to take notes and, feel free to test yourself along the way. But the first point, 529 savings plan can only be used to save for an in-state school, true or false? And the answer to that one is going to be false. So a big misconception is that it more matters where the school is located if you can use 529 money for it. But the important part of this context is whether or not the money is going towards what's known as a qualified expense. So 529 savings money can be used in pretty much any state. The key is making sure that it's used for qualified expenses, so the money comes out tax-free, both on a federal and state level. Biggest benefit of a 529 plan is the tax advantages. So you put in after-tax dollars, they grow tax deferred, and the money comes out tax-free on a federal and state level if they're used for education expenses. Now, a handful of those are listed up here. These are the more common ones, tuition and fees, room and board, books, supplies, computers. I'll throw on there dining hall plans and food plans. So basically anything directly billed to you by the school, that is going to be a qualified expense. There are also a few others out there that people don't really think about as much. So additional expenses for special needs beneficiary. If you're going to a private, elementary or high school, you can use up to $10,000 for K through 12 tuition expenses. And that $10,000 is per year. And you can also use up to $10,000 to actually repay student loans. So that $10,000 is a little different. That is per person, and it's a lifetime limit, not a per year amount. So you definitely want to be mindful of the difference there between K through 12 and the student loan repayments. And I really want to emphasize that you don't want to set up a 529 to pay off student loans. The whole idea of setting up a 529 is to avoid student loans. So this little tidbit here is really just an extra layer of flexibility that you'll have with 529s going forward. And another thing, this list is not all encompassing. There are other types of educational expenses out there, but these are the ones that you're probably going to come across the most. And again, a great rule of thumb is anything that is directly billed by the school or needed to complete the program, those are always going to be qualified expenses. On the flip side, you want to watch out for expenses that are not qualified. Now, if something is not qualified, when you take the money out of the 529 plan, you will have a 10% penalty on the earnings portion coming out of the plan, as well as ordinary income taxes on that earnings portion. So those can add up, of course. Contributions and principal amounts will never be affected by those. But again, if you have a lot of earnings in the plan, that ordinary income tax and then the 10% penalty can really add up. So really, expenses that are not qualified are any expenses that are not related to education. The ones up on the slide are the ones that people tend to think are qualified when they're not. So things like insurance, sports, or club fees. I'll add one more on there. Greek life dues. Those are not going to be qualified. Best way to think about that, anything extracurricular is not qualified. Excuse me. Transportation costs, how you get to and from the school, even if it's a school that's overseas, which some schools, a handful of schools actually allow 529 money to go towards international programs. Transportation costs are not going to be qualified. Another one I'll add here to the bullet points, anything related to tutoring or SAT, ACT prep, pre-college planning, Common App fees, things like that are not going to be qualified either. And just keep in mind the student loan amounts, that's an aggregate lifetime limit of $10,000 per beneficiary. And then K through 12 non-tuition expenses are not qualified. So that $10,000 per year for K through 12, that is only for tuition expenses. Question 2, you're better off sticking with your local plan, true or false? Well, I'm not crazy about the answer on this one because it really is, it depends. So technically speaking, you have, every state's 529 plan to choose from. And there are a couple of things that you want to look at when deciding between 529 plans. First and foremost, in my opinion, does your state offer some sort of tax incentive for contributions, whether it's to the local plan or it's to another 529 plan? And that's going to vary by state, and the amount is going to vary as well. So it's definitely in no way universal. That's the first thing you want to look at. Second thing you want to look at, of course, is the investment options, the long-term performance, the consistency, the management of the plan. Because a lot of times, even if you get a tax deduction, savings or a better performance in another plan can easily outweigh some of the savings from the tax deduction. So those, in my opinion, are the two things you want to look at. Sometimes it's better to stick with the local state plan, and sometimes you can go to other plans out there as well. Best way to, in my opinion, to get these questions answered for you, if you're not sure where to go, work with a financial advisor who understands the landscape, and they can help make that decision for you. Question 3, 529 plans can't be used for adults, true or false? Well, the answer to this one is false. So generally 529 plans are thought of as, used for people 0 to 18 years old going to a 2 or 4 year college or university. Well, they can also be used for adults because technically speaking, all you need to be the beneficiary of a 529 is a social security number or a tax ID number. So technically you can't set up a 529 for someone that's not born yet, but you can put it in your own name and then transfer it to them once they are born, because that is something we see people do. The point of this slide, though, there are no age limits to a 529. It doesn't matter how old you are, you can be a beneficiary of a 529 plan. And unused money, if you ever have leftover money in the plan, can be transferred to another beneficiary within the same family. And that's something we'll kind of touch on a little bit later in one of the slides as well. Question 4, 529 plans are just for traditional 4-year colleges, true or false? The answer to this one is false. So hopefully you're paying attention, you know that already, but you can use 529 plans for a variety of different educational institutions. That could be, again, K through 12, which we mentioned. It could be 2 and 4-year colleges and universities, junior and community colleges, vocational or apprenticeship programs, post-grad programs, doctorate degrees, really any type of qualified educational institution that is out there. And if you want to get very specific, it is an educational institution that meets specific federal accreditation standards. Now, most places will meet that. The only time you really have to be concerned if it's some sort of online institution that is only online, is very small, and really no one's heard of it, or if it is a school that's overseas. And again, there are a lot of international programs that do allow for 529 money, as long as they have a federal code, which is something that you can look up on the IRS website. Again, most 2-year and 4-year colleges and universities that you find in the US, those are going to be fine. So you don't have to worry about that per se. But at the end of the day, we want to show you how flexible 529s are when it comes to using money for different types of education programs out there. Question 5, 529 accounts are difficult to open and maintain, true or false? I always find this question kind of funny because I don't know how to justify it if the answer is true. So thankfully, the answer is false. Ultimately, there are two types of 529s. There are direct sold 529s where you as the client go through a state's website and set it up on your own and you manage it on your own. Or there are broker sold 529s where you would work with a financial advisor directly and they would help you with pretty much everything in the process, opening it up, setting up the allocations, your goals, the investments, the time horizon, and really just tailoring the account to making sure it is exactly what you need and that you're getting all the benefits out of it that you should be getting. So, of course, there are pros and cons to each. A lot of people like working with an advisor and think it's a lot more straightforward and they tend to have a lot more knowledge. But generally speaking, as a whole, the 529s out there are pretty straightforward to open and maintain. Now, of course, I haven't opened one in every single state, so I don't specifically know. Certain websites might be a little more cumbersome than others, but for the most part, it is a very straightforward process and it can be really simple and not time consuming at all. Question 6, high income earners can't contribute to a 529, true or false? And the answer to that is false. So basically, there are no income limits when it comes to 529 plans. It doesn't matter how much you make, whether it's 50,000 a year or 500,000 a year, anyone can contribute and anyone is eligible. And this is actually what makes 529s really interesting from an estate planning standpoint. So we talk about 529s as a vehicle to save for education, but it's actually a very useful estate planning tool. And there are a handful of reasons for that. So first and foremost, what's unique to a 529 plan is what's known as a 5-year accelerated gift. So as it stands in 2023, the gifting limits are 17,000 per individual, 34,000 for a couple filing joint. With a 529 plan, you can actually gift up to 5 times that amount, aka 5 years, in 1 year per beneficiary. And the whole idea of gifting and gifting within the annual limits is so you don't have any sort of estate tax or gift tax or really even have to file any tax forms. Well, the 5-year accelerated gift works the same way. And it allows you to put a lump sum of money into a 529 plan to grow sooner rather than later. And that's a great thing to take advantage of, especially if you think about, older clients looking to get money out of their taxable estate. That is a great way to do that because when you fund a 529, you are removing assets from your taxable estate. And again, this 5-year gift is only something you can do with a 529 plan. Everyone here has a current lifetime gift tax exemption of just shy of $13 million, meaning you can actually go over these annual limits and the 5-year gift limits and use up to $13 million before you have to think about really estate taxes or gifting taxes. So unless you're a very, very high net worth client, you have a lifetime gift tax exemption to use. So if you're thinking about estate planning right now, this is definitely a good time to be transferring assets and passing down assets. 529s are a great way to do that. I'll walk you through one example here. I won't spend too much time on this, but as I go through this slide, please do me a favor and don't marry yourself to some of the high amounts in this example. So I know you see 170,000 here for each of these grandkids. Those could be 17,000 and it could be $1,700. I just want you to focus on the principles as I walk through this example because the principles are the things that are going to stick in any example, no matter what amount. So Susan and Howard, they're a grandparent couple for Jordan, Lisa, Drew, Mike, and Tracy. Those are their 5 grandkids. And then you have Adam and Melanie, the parents of these 3, Jennifer and Tim, the parents of Mike and Tracy. So Susan and Howard, the grandparents, they did that 5-year accelerated gift that we mentioned in the last slide, filing joint. So they put $170,000 into each of the 5 grandkids' accounts all in 1 year, which is absolutely something you can do. And again, you don't have to worry about gift or estate taxes because you're technically in the 5-year limits. So in doing so, over the course of the next 5 years, they're removing $850,000 from their taxable estate. But as the account holders, they maintain control of those assets as long as they're listed as the account owner. So unlike a custodial account or even many types of trusts, Susan and Howard do not give up control once any of the grandkids reach a certain age. It is always going to be within their control. The only times that would change is if Susan and Howard unfortunately pass away, or they become incapacitated, or they simply say they want someone else to be the account owner and they change account owners. So you're removing assets from your taxable estate. You maintain control as long as you're listed as the account owner, which again, you can control the investment options, the distributions, all of that stuff. And the assets are revocable, meaning that if Susan and Howard decided they want to take the money back, spend it on a vacation home, they have unexpected financial hardship, they overfunded the 529, whatever it might be, they could pull that back into their estate and use it for something else. Now, of course, that's technically a non-qualified expense, so they'd have to be mindful of that. But the principal portion that they've put into the plan will never be taxed or penalized in any situation. So those are a lot of great benefits to have, in my opinion. It's very rare that you can say that about an investment vehicle where you get the assets out of your estate, they're revocable, and you maintain control for as long as you're listed as the account owner. There aren't many options like that out there. And of course, you're getting tax deferred growth. And if the money is used for education, it comes out tax free. So in the rest of the example, Adam and Melanie, they did 170K for their 3 kids. And then Jennifer and Tim, 340K and 170 each for their 2 kids. They remove assets from their estate. And of course, the best part of all this, each child has a very high account balance to start with, which will grow tax deferred over time. But again, don't marry yourselves to these numbers. The exact same principles that I just mentioned will apply even if those numbers were much lower. So this is a slide I'm going to pass through because I don't think it's very relevant for this presentation. Same thing with this one as well. Basically, if you have money that, if you're thinking about setting up a trust versus a 529 and you know the money is going to be used for education, 529s are going to be a lot less expensive in terms of the tax ramifications. So if you know the money is used for education, will be used for education, you definitely want to think about a 529 before setting up a trust. We've talked about this. So we'll go on to question 7. You'll lose your savings if your child doesn't go to college. True or false? The answer to that is false. So there are a lot of things to do with leftover 529 money. The most common thing people do is they transfer it to another family member of the current beneficiary. And that could be anyone within the family. That could be the aunts or uncles. It could be the parents or grandparents. It could be a sibling. It could be a cousin. It could be an in-law or even a spouse. As long as there's a familial relationship, you can transfer those assets over and help pay for that person's education. We talked about no tax or penalty on withdrawals from principal if you have taken non-qualified distribution, but distributions are taken pro rata. So you can't pick and choose between contributions and earnings in a 529 like you could a Roth IRA. So whatever percentage breakdown is in there, that same percentage breakdown will come out of the 529 plan. Question 8, anyone can contribute to a 529, true or false? Well, the unique part of this question in the presentation, it is the only one that is actually true. So yeah, anyone can contribute to any other person's 529. You do not need to have any sort of relationship with them. I, in theory, could contribute to someone's 529 here, even though I have no knowledge of who you are prior to this meeting. I won't be doing that, but to give you a sense of how easy it is to basically crowdfund a 529, that is how easy it is. It is a very flexible investment vehicle in terms of who can fund it. And this is what makes 529s more popular around, gifting with the holidays or with birthdays, instead of family members giving, tchotchke gifts or one-off items for Christmas or Hanukkah or, whatever you're celebrating. They will give contributions to 529 plans. So that is a great way to help fund a grandchild or a child's education. Question 9, savings in a 529 plan dramatically reduces financial aid eligibility. Again, another question where thankfully it's false, because I really am not sure how I would answer it if it were true. So simply put, 529 plans do not have a big impact at all on federal financial aid eligibility. How schools determine it is up to them, and that's on a case-by-case basis, so there's no straight answer to that part. But from a federal aid standpoint, a parent-owned 529, only 5.64% of those assets will be considered when it comes to calculating federal aid. So simply put, if you have $100,000 in a 529 plan, only about $5,600 will go against aid eligibility. When it comes to federal aid, for the most part, most people have the biggest hit when it is their income. So if you want to get a good sense of if you're going to get aid from the government and FAFSA, you want to look at your income first and foremost. But thankfully, 529 plans do not have a big impact on federal aid eligibility. And to take it a step further, if you have a non-parent owned 529, like a grandparent or another family member owning it, there's zero impact on financial aid whatsoever, which actually kicks in this year, which is a great thing. So we'll skip through these next slides because I don't think we need to compare them to other investment vehicles. And then question 10, if your child wins a full scholarship, you'll pay a penalty on withdrawals from 529 savings plan assets. The answer to this is it's false. I know this says mostly false, but it is fully false. So any amount of scholarship that you get, you can take up to that amount out of the 529 plan and avoid the 10% penalty on the earnings portion. So let's say you get a $50,000 scholarship, you can take $50,000 out of the 529, and whatever earnings portion is in there, it'll only receive ordinary income tax. It won't receive that 10% penalty. That's why the answer to this is mostly false. So scholarships are a good thing, and they're not going to penalize you if you have money in a 529 plan and you receive a scholarship. They give you a little bit of flexibility there. So scholarships are, of course, very, full scholarships, at least in this example, are very unlikely for most people. But that being said, if you are in a situation where you have a lot of leftover money in a 529, there are a lot of options that you have when it comes to what to do with that money. So, of course, you can use it for education expenses not covered by the scholarship. Then there are a lot of things out there. It could be, dining hall or off-campus food, off-campus housing or on-campus housing, different types of supplies. It's rare that a full scholarship covers absolutely everything. You can let the money grow tax deferred in the account and continue to let it sit there and use it for a later advanced degree or higher education later in life. You can change the beneficiary to another family member, which we went through that example before. You can use up to 10 grand to help pay off student loans, whether it's for that person or for other family members as well. So you can bounce that around and use 10,000 for multiple different family members. And then, of course, we talked about the scholarships. You could take up to that amount out. And then starting next year with the Secure Act, you can actually move up to $35,000 from a 529 to a Roth IRA. If it's left over, that is tax and penalty free. So if you want to learn more about that, definitely talk to a financial advisor or someone on the flagship group, because they can really help walk you through that. So with that being said, again, think about concerns for your children when it comes to their education, because it's going to be one of the more pressing and emotional financial needs that anyone is going to have. I mean, you're saving, money for your child's degree or grandchild's degree, or even a future child's degree. And that can be a huge launching pad for them in life when it comes to their employment situation, how much money they make over the course of their career. Ultimately, just don't wait to have the conversation with your advisor. There is a lot of information in this world in terms of the education planning world that you want to be aware of when it comes to going through this process, whether it's related to financial aid, setting up a 529, thinking about, student loans, where to go to school, all of that stuff. So with that being said, Krista, I will turn things back over to you. I appreciate you and the team having me on. And if there's anything else that you feel I should mention, please let me know.
I think we're good. Thanks so much, Stephen. We really appreciate it.
Yeah, of course. Do you want me to, I'll put this up here just to get the disclosure slides in here as well.